If you or your partner has an adjusted net income over £60,000 and your household still gets child benefit, you've probably heard of the high income child benefit charge, the tax charge that claws some or all of it back through your tax bill. What you might not know is that since September 2025, some families can pay that charge without ever filing a self-assessment tax return at all. This isn't automatic and it doesn't apply to everyone. I'll walk through exactly who qualifies. But if the only reason you've ever filed a tax return is this one charge, what I'm about to show you could save you an annual headache. Stick around too, because later I'll show you a genuinely odd quirk in how this charge actually gets calculated, one that often gets missed in simplified explanations. Welcome back to Money Under the Microscope, helping you make finance clear. I'm a chartered financial planner, advising clients since 2016. So, who actually gets caught by this? The key figure is your adjusted net income, not simply your salary. It includes taxable income like savings, interest and dividends after certain deductions such as qualified pension contributions and gift aid. The charge applies if you or your partner's adjusted net income is over £60,000 in a tax year, based on whichever one of you has the higher figure, not your combined household income. Between £60,000 and £80,000 you lose 1% of the child benefit for every £200 over that threshold. Once your adjusted net income reaches £80,000, the tax charge equals the full amount of child benefit, so there's no extra money left from claiming it. Here's what that looks like in practice. Say you've got 2 children and your adjusted net income is £67,600. For this charge, HMRC counts 53 relevant benefit weeks in the 26-27 tax year, which gives a full year child benefit figure of £2,382.35 before any rounding. You're £7,600 over the threshold, which works out at 38% clawed back. Run the math straight through and you'd expect a charge of around £905.29. But that's not quite the number HMRC actually charges you, and the reason why is the odd little quirk I promised you earlier. Until recently, if you owed this charge, there was really only one way to pay it. Register for self-assessment and file a tax return every year just for this. Since September 2025, HMRC has offered a second route. If this charge is the only reason you'd otherwise need to file a tax return, you can now pay it directly through your PAYE tax code instead. HMRC adjusts what your employer or pension provider deducts, and once you're registered, you won't need to do anything else unless your circumstances change. There are conditions though. It only applies from the 25-26 tax year onwards, and you need to register by the following 31st of January. So for the 25-26 charge, that deadline is the 31st of January 2027. And if you already file self-assessment purely because of this charge, don't just stop sending returns. You'll need to phone HMRC to leave self-assessment and register for the PAYE route instead. If you're filing self-assessment for another reason entirely, self-employment, rental income and so on, you'll still declare this charge there. Just a quick interruption. If you're finding this useful, there's a quick way to support the channel by hitting the subscribe button. It costs nothing and it really helps Money Under the Microscope reach more people. Right, let's get back to the video. Now, some families avoid receiving the money by making a child benefit claim but choosing not to be paid, what's called opting out. That's very different from never claiming child benefit at all, and the difference matters more than you think. If the person registered for child benefit has a child under 12, staying registered and simply opting out of the payments preserves their automatic national insurance credits, which can help protect their state pension record. Those credits go to whoever's actually registered as the claimant, not automatically to whichever partner earns less. But if a family never claims child benefit at all, often specifically to avoid this charge, those national insurance credits are never earned in the first place, and that can leave a genuine gap in someone's state pension record. The government is planning a service that may allow eligible parents and carers to claim replacement credits for qualifying periods from the 7th of January 2013. It was originally due to open in April 2026 and it's now been delayed until April 2027. Here's a myth worth busting before you go and opt out today. opting out stops future child benefit payments, but it doesn't erase a charge you've already built up earlier in that same tax year. That's because the test uses your adjusted net income for the whole tax year, not just from a particular date. So a bonus or pay rise late in the year can create a charge on child benefit received months earlier. And if you opt out partway through the year, that doesn't erase the charge already due on payments received before you stopped. Opting out isn't a reset button, it's a stop button. As promised, here's that quirk. This charge isn't just calculated by simple percentage. By law, HMRC can round the calculation down at up to 3 separate points. First, the relevant child benefit total is rounded down to the nearest whole pound. If the taper percentage itself isn't a whole number, that gets rounded down too. And finally, the charge itself is rounded down to the nearest whole pound. Go back to that 67,600 example. In our case, the percentage lands on exactly 38%, so only 2 of those roundings actually change anything. £2,382.35 becomes £2,382. 38% of that is £905.16, and the final charge is rounded down again to £905 exactly. It's a tiny detail, but it's exactly the kind of thing that separates the statutory answer from a quick percentage calculation, and it's rarely explained clearly. So, if you or your partner has an adjusted net income over £60,000 and your household gets child benefit, check whether you can now pay this charge through your tax code instead of self-assessment. Know that opting out preserves your national insurance credits only while your child's under 12, and that never claiming at all can leave a real gap. And remember, opting out stops future payments, but it doesn't cancel what's already built up. If this channel helps, please hit the like and subscribe button. I'm Money Under the Microscope, and I'll see you on the next one.